Good morning, everyone. Welcome and thank you for joining us today for the second webinar in our underwriting webinar series on office properties. We know your time is very valuable, so this webinar will only be 30 minutes, but will be packed with information in a discussion hosted by Peery, Vice President of National Asset Services. She is joined by two expert panelists, Neal Jernigan, partner at Crossley, Jernigan, and Ellison, and attorney Paul Rubenstein. If you have any questions for the panelists, please submit them using the Q&A feature on Zoom. A quick disclaimer before we get started. NAS Investment Solutions is not a tax, legal, or financial advisor and did not host or participate in today's event with the purpose of acting in any of those capacities. The information that will be shared with you today is not intended to be personal advice. Everyone's situation is different, and you should always seek the advice and consultation of your own independent tax, legal, and financial advisors before taking any action with respect to your personal financial affairs. And without further ado, I will now hand it over to Adi and our panelists.
Hello.
Good morning.
Good morning. Hi, everyone. Welcome to our underwriting series. As Roxanne said, this is about multi-tenant office buildings, and we'll be presenting it from the sponsor and asset and management side, as well as the brokerage and legal perspective. And of course, we're going to have to discuss now what changes are happening in the era of COVID. It is going to be really nice when we can finally say the post-COVID era. I'm looking forward to that. We have quite a few pertinent questions that we received from the participants, and they fit within the agenda that we just wanted to set out for today. And I'd like to get through as many as possible. But if we don't get to your question, please know that you can email us on the side. We're happy to respond. Okay, so the first question is, how do you take initial steps to form a team when investing? I actually really like this question because you're actually looking at one of the core NASIS teams right in front of you. And I have to say that over time, as you're working through different investments and you're working with different legal teams and different brokers, you start to align with those that meet your core values, that you can really trust, and that have a breadth and depth of knowledge. And as you get to working on different investments, you become a team and you become fluid and you understand the different hot points and the red flags, and it all just kind of comes together. So I think the best way to answer this question is you cultivate that team over time. And you're looking at three really great members of this team. Okay, another question that came up. General overview of the underwriting process. And that's the meat of what we want to get to today. And from a 30,000 foot level, I can tell you from a sponsor perspective, it's really vetting the strength of your income stream and understanding your expenses. But there are so many complexities and nuances to this. So I don't know, Neal, you want to talk about some of the expenses to look for when you're underwriting process?
Well, from an expense standpoint, today, certainly in the era of COVID, we are seeing a lot of management issues relative to cleaning. We are seeing some opportunities there that for HVAC modifications and changes relative to ventilation, all of which are going to be expensive for some landlords that may or may not be able to be passed along to tenants that are going to impact the economic viability of some of the assets that we're looking at. So those are over and above the typical normal expenses that we have traditionally underwritten. So, but they are a very real problem in today's underwriting because in a lot of cases, we haven't identified all of those costs as of yet.
Right. And I think a lot of them will be upfront costs, right? We've talked about how bathrooms are going to be more touchless. how you're going to handle elevators if you're in a stacked building and keeping people from, too many people from getting in the elevator, the sanitation.
All of those things. And in particular, for example, all the trend today will be for office services to be more antimicrobial. We're going to see the workstations that have historically been 4x3 with a single panel between them. There'll be, 4x6 or 6x6 or 6x8 with 3 panels, separating the occupants. We're going to see more private offices. The co-working space, I think, will materially diminish. People like WeWork are going to have a very tough time in some cases. Many building lobbies are going to be totally retrofitted in some ways, depending on how they were used in the past. And most common areas will become much more touchless than we've ever seen. For example, bathroom doors, they are going to cease to exist. They're going to be more like the airport terminals where you walk in.
Well, that's going to be interesting.
Well, just a design criteria issue, of course, but I think we're going to see those certainly going forward in building design, and it's a material issue in new construction and keeping tenants. I mean, the thing that we all are focused on is we need to have our tenants comfortable in coming back to the office. That is a critical issue for the viability of the office asset.
Yeah, and I think also when you look at capital improvements and capital items in the new COVID era, when you're thinking about tenant improvement dollars for the vacancies and for renewals, how tenants might want to change the dynamics, right? They want more space, more plexiglass. Can you talk a little bit about that?
Yes, I mean, I think the issue of having 6 people in a 150 square foot room, conference room, is in the past. We're seeing a number of office tenants that are going to have more space as a result of the COVID. Now that'll be offset by, of course, the work from home concept as well. So that is yet to play out from an underwriting standpoint of whether we're going to need a lot more space, a lot less space, or something in between. And my guess is it will be something in between. But I can assure you that most office tenants are evaluating their office configurations and how they are going to go forward with keeping their employees safe and all of that.
Yeah, and I think landlords will have to add a little bit extra in tenant improvement dollars just to be sure and to make people feel safe to come back to the office. So speaking of tenants, Paul or Neal, are you seeing lenders looking at tenants differently and how they're underwriting?
Maybe I'll start on this one, Neal. Since I just completed a refinancing on a mid-rise office building here in Santa Monica, which was one of the hottest markets around. And what we found is that the lender looked at every tenant in the building, not just major tenants. They looked at every tenant. They looked at, obviously, financial viability, although in this particular office space, we didn't have a lot of quote credit tenants. These are your smaller service type offices, maybe 2,500 to 5,000 square feet each. So the credit per se wasn't an issue they could get their teeth into, but it was things like office usage. How many people were actually coming into the office on a daily basis? How much of the work that the tenant did could be done remotely over a long period of time? So they're looking at it in a much more dynamic fashion and much more concerned about, over the long haul, is this tenant's use likely to require the space they have, or is this going to be, as Neal points out, in some circumstances, will they need more space because their people will come back, but they're going to need more square foot per person? Or what I think is pretty much on everyone's mind, will they ultimately need less space so that economically you know that at some point the landlord is going to be hit with requests for either lowering the rent or taking back space or a combination of both. So yeah, underwriting at this point has become much, much more granular. Neal, I assume that's your experience as well.
It is, Paul. Absolutely. I mean, it's amazing that the lenders will take the rent, as Paul said, will take the rent roll, and they will ask the tenant or the borrower how the tenant is using the space, how many employees they have, and how many of them are actually in the office, how many are working from home, how many are coming in 2 days a week or 3 days a week. They are down to literally a person count per space per day type of underwriting, which is about as granular as we've ever seen it, for sure.
A lot of intel to collect. So even not in the COVID era, it's important to understand your tenants, right? Just understanding their credit, their viability. Is it a diversified tenant base? And just old-fashioned reviewing the leases, really. I mean, understanding if there's outstanding rent credits or tenant improvement allowances that could come later in the term, and making sure you get credits for those at the close. Checking if tenants have first right of offers for purchasing the building could come up. And that could affect your exit strategies. Tenants that have first rights of refusal for vacant space that's adjacent. If you had a tenant that may have been interested in expanding, like you said in the COVID era, that restricts your underwriting. So many pieces of this come into play. Somebody had circulated, by the way, an article that I thought was interesting, and maybe you can give your perspective, that office may see a shift in moving to suburban markets too, because people don't want to stay away from the downtown area where it's close proximity, where you have amenities that are in tight quarters, or you need to take public transport. Have you seen anything pop up regarding anything of a suburban shift?
Well, I can address that a little bit, Adi. Supposedly there is a bit of a shift. I mean, let's face it, if you're in an urban core location, taking mass transit to the office is somewhat disconcerting and problematic. And the idea of populating a 70-story office building, even with multiple elevators, that you can only put 2 people in an elevator at a time, is creating a certain level of difficulty for sure. So a lot of those tenants are saying, well, we really don't need to be in the urban core. We can be in the suburbs. It is driving some people to look at underwriting and buying low-rise office. In particular, one story is kind of become the darling of the industry again, which effectively Class B space, but it is works really well in the time of COVID. So we are seeing some push in that direction for people that are interested in buying that type of product. It'll be interesting to see if the tenant movement is in that direction, but my sense is it will be. I mean, we are aware of certainly firms in New York City that have had, a downtown major office presence, but they would have a secondary office or whatever in the suburbs, and a lot of the tenants or a lot of the occupants of those downtown spaces were, instead of going downtown, were going to the suburb space. So that's going to drive a demand for that product.
It'll be interesting to see what develops, and underwriting is definitely getting more detailed. And you really got to pay attention to every rock, turn over every rock for income and expense. I'd like to move to another question. What is happening to cap rates and LTV, loan to value? Paul, are you seeing when you're working with lenders, anything on the LTV side?
Yeah, it's really the mirror of what they're doing with respect to underwriting leases. So lenders are becoming, the one thing lenders hate is uncertainty. So, and their answer to any uncertainty is raise interest rates and lower the amount that they lend. So they have reacted, I think, in a predictable fashion. Interest rates are historically low and remain low. There's not much they can do there, but they clearly are attacking loans from an LTV standpoint, a loan to value standpoint. So where they might have in the past on a specific property loaned 65, 67, maybe even up to 70%, you're now seeing loans. If you get to 60, you're saying, boy, this is great. Often you're looking at 55. Other areas where they might have been more expansive in the past, like providing some interest-only periods, now those are being cut back, and they're looking to have their amortization kick in either immediately or sooner than they might otherwise have done a year ago. So yeah, it's just a more conservative environment, and you're going to have to assume that your debt to equity is going to be less than it would have been a year ago on the same asset.
Yeah. And what's happening with cap rates, Neal?
Well, I would say, other than single tenant net lease office buildings to investment grade credit tenants, cap rates in general are going up. Simply because, let's face it, urban core buildings are, extremely uncertain as to their operations going forward. So that's going to create some uncertainty in for lenders and buyers. Same thing's true even in the suburbs. I think everybody's concerned about office usage, and so with that uncertainty, we're seeing cap rates go up. So it's just a reflection of the risk in the market, and which is just the way that it basically indicates the efficiency of the market in evaluating risk, which I think we're all a little surprised at how efficient it is sometimes.
Yeah. Okay, moving on to the next question. How are lenders evaluating loans? And I think if we address this topic, it's important to know if lenders are taking different stances with legal language within the loan documents. Legally, Paul, are you seeing any contract changes in the language just relative to COVID? We touched on the income side, right? How they're looking at every lease and what's changing in the major lease.
What I am seeing is more of an insistence or less of a willingness to negotiate on sort of these broad provisions that lenders love to throw into mortgage documents that just say they have the right to declare a default if they don't like something. The circumstances have changed. We woke up this morning and we don't like this property as much as we liked it the night before. That's sort of my reference to this. And in the past, I was usually, these are sort of standard provisions you see over and over again in CMBS and other institutional lender documents. And I've typically been able to negotiate something that says, well, it really has to affect the ability to pay the loan back or the value of the property. The last couple of deals I've done, the lenders have shown no willingness to change those provisions. Again, they want maximum flexibility if the market, when I say the market turns on them, basically 6 months from now, we still don't have a vaccine. We still don't see what's happening. And we're beginning to see a real downturn in tenants' ability to remain in their business places. And that's the concern that lenders are really trying to get ahead of.
Yeah, and that hesitancy can really affect a buyer's ability to buy, and it's time consuming and all the fluctuations. Are you seeing anything different, Neal?
No, I think Paul is right on with that. I mean, the interesting thing is that those clauses have a bit of subjective flavor to them, right, Paul? In the sense that, gosh, I don't feel so good this morning. Maybe we ought to default that loan. I mean, it's really pretty scary from a borrowing standpoint when you have that much subjectivity in the loan documents, which I know is what Paul's trying to get out.
Oh, interesting times for sure. Okay, another question we have is, can a TIC property still be refinanced? Well, I know in the last few years, some were getting done if there were 10 ticks or less. It's an inherently flawed structural model. And those on the call who are on the webinar who are in TIC deals with 20 or 30 people, trying to get unanimity with, leasing and when to sell, it's insane. So I know lenders have really tapered down on that. Neal or Paul, are you still getting any TIC deals through?
For me, the last one I did, which was pre-COVID, a little over a year ago, when we went to refinance, an absolute requirement from every lender we talked to was that we do a roll-up. They just wouldn't even talk to us with a TIC structure. Now we had about that deal. We had, I think, 26, 27 TICs. But I don't see lenders sort of willingly going into TIC deals at this point. They'll we can still obviously do the Delaware statutory trusts, which have their own issues, but at least from a operating standpoint, decisions can be made without having to deal with the one dissident TIC if that happens.
Yeah, I imagine lenders, they're not looking favorably on that model right now.
No.
Another question, what are some up and coming markets? Neal, what would you say is a hotspot these days?
Well, certainly the coastal markets always have a certain attraction, but I would say any market that is heavily technology based and life science based are certainly going to be the hottest markets for office these days. So in particular, I mean, aside from the New York and LA but you got Atlanta and you've got Dallas, you've got Austin, all of which, Denver, all of which are big technology areas that seem to be doing quite well. And I would guess that any coastal city with technology that was basically did not have hurricanes would be a pretty good area for investment.
Yeah. And what are the pros and cons of office? I'll start that one. I think one of the pros really is generally low levels of delinquency and higher occupancy. But now as we're addressing the COVID area, it'll be interesting. I think your underwriting is going to have to assume a little bit more vacancy to be conservative. But what other pros do you have, Neal or Paul, for office structure?
Well, I think, as you say, I mean, the major advantage to office has traditionally been that there's just a level of stability there that you don't typically get in retail or some of the other market segments. And that's, of course, what is now most concerning is how stable is that market, and to some extent, how is it going to need to be repurposed, especially for some of if you're involved in the larger high-rise kinds of markets. I mean, if what we're hearing is correct, and I have no reason to think it's not, that places like Manhattan or downtown Los Angeles or whatever on their high-rises are seeing only 10 or 15% of the actual people come back into the buildings. And knowing, I mean, I do know, because I was a partner in a very large law firm, and I still have a lot of friends who are. I mean, the large law firms, I assume large accounting firms, the large service companies are really thinking strategically, trying to rethink what their use of space will be in the future. And that's going to evolve over a little bit of time. And I think we may need to do some real creative thinking in the future about how, whether some tall office buildings, for instance, become multi-purpose. Are you going to have some residential, have some floors that are residential with office in other parts of the building? I mean, things like that, I think, are on the horizon.
Yeah, it'll be interesting to see the future, what happens in the future with office. While so many of us are working from home and thriving, I think generally people want to be around other people and they want the camaraderie and they want to be around the water cooler, so to speak. So it'll be interesting, especially once a vaccine is in place and we've had time to absorb that. Neal, any other pros or cons you can think of for the office?
Well, I think you hit the nail on the head about delinquency on the pros for office, which historically has had a fairly low delinquency rate, and certainly the service and knowledge-based industries, which are kind of driving our economy, are going to drive demand for office, although it'll be tempered by COVID going forward. I think from a con standpoint, sometimes it might be perceived as a little bit more management intensive than, say, industrial or single tenant net lease type products. The rehab or retenanting costs sometimes can be quite extensive, and they continually occur. It's not like an industrial deal. You put the guy in and he stays a while, and when somebody else comes, they pretty much take it as is. It's a little different in office sometimes. And of course, I think we're all experiencing the impacts of pandemics, which can have some devastating impacts on underwriting. So that's certainly an area that hopefully will get sorted through going forward in a post-COVID era.
Yeah, and as we discussed, the different tenant improvement allowances you might need for, and the HVAC. So adding layers to your underwriting will be definitely something. How are we doing on time, Roxanne? We have just about a minute.
I was going to say, if you have one last question to address, then you can do that, or I can take it from here and wrap this up.
Well, okay. How do you evaluate future environmental risk? Neal, maybe you can touch on this one.
Well, I think a couple of things. First is when you're doing your due diligence on the property, you're gonna look at the tenant and see how they're going to use the property, use the building. For example, we had a deal recently that was a great deal, New York Stock Exchange company, but they were handling medical waste, which created a concern for us. So we passed on it. But you're gonna evaluate the tenant's use during your due diligence. You're gonna evaluate the environmental report, and in that environmental report, you're gonna be looking at the surrounding properties. And those surrounding properties will, you'll be able to pinpoint which ones may create an environmental problem going forward. And if you think that there's a problem, you probably should steer clear of the deal. But that's the best way I know to evaluate potential environmental risk. And certainly you're not going to do a deal that's got an environmental problem to start with.
Yeah, especially not now. Okay, Roxanne.
All right. Thank you, Adi. Thank you, Neal and Paul. And thank you to the viewers for submitting these questions. A recording of this webinar will be available on our website in a few days. That's nasinvestmentsolutions.com. You'll receive a brief survey via email after the webinar, and we hope you take a minute to let us know your thoughts. Thank you very much.
Thank you, everyone.
Thank you.
Thank you.